If you're tracking the really big shifts happening in the market, you definitely know where we're headed today. Micron Technology, ticker MU.
Yeah, and we're jumping in right at, well, what feels like a massive turning point. I mean, just look at the stock performance. It's been uh, explosive.
Explosive is the right word. What are the numbers?
Over the past year, Micron's return shot past 91%. Just think about that compared to the S&P 500, which did, what, maybe 16% in the same time frame? It just blows it away.
It's an absolutely huge run. So here's what we need to do in this deep dive, folks. We've got to unpack this idea that Micron is like fundamentally changing.
Right. The old story was volatile, cyclical memory chips, boom and bust.
Exactly.
Yeah.
But the new story, the one everyone's talking about, is Micron as this mission-critical piece of the whole AI supercycle. Much more stable, much higher value.
So our mission here is really to poke at that. We look at the sources, the analyst reports calling it a strong buy, and ask, is this real? Is this a structural shift the market's still undervaluing? Or, is it just the top of another cycle?
Okay, good plan. Let's start unpacking that shift right where the action kicked off. Those blowout earnings for fiscal Q4 2025. Now, we've seen memory companies post big revenue jumps before, right? What made this one different?
Well, yeah, the revenue jump was big, $11.32 billion, up 46% year over year. But the real eye-opener, the thing that made people sit up, was the margin. Non-GAAP gross margin hit 45.7%.
Okay, 45.7%. What was it before?
The year before it was 36.5%. That kind of expansion is huge.
Right. And in a business like chip making, with all those massive upfront costs, fabs and all that, what does that kind of margin jump really signal?
It screams operating leverage. It's crucial to get this. Building memory chips cost a fortune up front. So when prices go up or even just stabilize, each extra dollar of revenue doesn't just add some profit.
It adds a lot of profit.
Exactly. Once those fixed costs are covered, most of that new revenue drops straight to the bottom line. It's like flipping a switch.
And they're basically saying the switch is staying on. The guidance they gave was pretty staggering.
It really was. For fiscal Q1 2026, they're forecasting revenue climbing again to $12.5 billion.
Yeah.
And get this. They expect non-GAAP gross margins to hit 51.5%.
51.5%. Wow.
When a company guides margins over 50%, they're telling you, look, we're not just selling a commodity anymore. This is something different.
Which takes us straight to why they have this pricing power now. It's the tech validation, isn't it? The huge catalyst. Micron getting into NVIDIA's big new platform.
That's the one. Getting designed into NVIDIA's H200 and especially the next-gen Blackwell GPUs, that's like the ultimate seal of approval in the AI world right now.
It basically proves their specialized memory, this HBM3E stuff, is top tier.
It proves it meets the toughest specs for performance, for power, for reliability, everything NVIDIA needs.
And then, here's the part that really seems to break that old cyclical mold. The CEO actually said their HBM production is completely sold out through 2026.
Yeah, fully booked. That's just incredible visibility for this industry.
Unheard of, right?
Pretty much. Usually, it's all about guessing demand quarter to quarter, having 2 years of demand locked in for your highest margin product. That suggests this AI demand really is structural, powerful enough to maybe override that historical boom-bust cycle, for now at least.
Okay, so HBM is the key. Let's just quickly clarify for everyone. We know Micron makes memory, but what are the main types, and where does HBM fit in that picture?
Sure. So basically 2 main buckets. You've got DRAM, that's the fast working memory your computer uses while it's running things. It's their biggest revenue source usually.
Right, like the RAM sticks.
Exactly.
Yeah.
And then you have NAND flash memory. That's for long-term storage, the stuff that stays when the power's off. Think SSDs, USB drives, that sort of thing.
Got it. So HBM is a kind of DRAM.
Yeah, you can think of it as DRAM on steroids.
Yeah.
It's super high performance, specifically engineered for these massive AI models.
Why do AI models need this specific type so badly? Can't they just use regular DRAM?
Not really. Not efficiently anyway. These huge AI models, they need to access just enormous amounts of data all at once, like instantly. Traditional DRAM, the way it's structured, just doesn't have wide enough pathways, the bandwidth to feed those AI chips fast enough.
It becomes a bottleneck.
Major bottleneck.
Yeah.
HBM solves this by stacking memory chips vertically, creating these super wide data highways. It just massively increases the speed data can move in and out.
And you can see the shift happening in their revenue breakdown, right? AI stuff was a small piece just recently.
Tiny, well, not tiny, but relatively small. In 2023, AI-related memory was maybe 15% of their DRAM revenue.
And now.
The projection is that by 2026, it'll be over 40% of DRAM revenue. That's a massive shift. The core of the business is moving from, standard PC and phone memory towards this high-value AI memory.
And the profitability follows.
Absolutely. We saw that margin number earlier, right? The specific unit that handles HBM, the cloud memory business unit, reported a gross margin of 59% in that last quarter.
59%. That's way higher than the overall company average of, what, 45.7%?
Yeah, almost 14 points higher. That difference, that's the smoking gun. You don't get nearly 60% margin selling standard stuff. You get that selling specialized critical tech for the hottest area in computing.
Okay, so if tech is great and the margins are fantastic, the next big question is always competition. This is still an oligopoly, right? Just three main players controlling almost everything.
Yep, classic oligopoly. You've got Micron, Samsung, and SK Hynix basically running the whole show. Over 90% of the market between them.
And historically, who's been leading in this HBM race?
SK Hynix definitely had the first mover advantage. They still hold the largest market share in HBM right now.
But the interesting dynamic, the opportunity for Micron, seems to involve the third giant, Samsung.
Exactly. Samsung is, the biggest memory maker overall, but word is they're hitting some snags, getting their latest HBM3E validated by the big customers, like NVIDIA. They seem to be falling a bit behind in this specific critical race.
Which creates a potential opening for Micron.
A huge opening. If Samsung is struggling, Micron is perfectly positioned to step in and grab that share.
So, okay, Micron's benefiting from Samsung's issues, but head-to-head with SK Hynix, the current leader, what's Micron's specific edge? What makes their HBM stand out?
The big one they keep highlighting is power efficiency. Their HBM3E apparently uses about 30% less power than the competition's offerings.
30% less power. I mean, that sounds good, but how big a deal is that really for a data center?
Oh, it's massive. Think about these hyperscale data centers. They're running maybe tens of thousands of these power-hungry GPUs, 247. Saving 30% on the power just for the memory, that adds up incredibly fast.
And it's not just the electricity bill, right? It's cooling, too.
Exactly. Less power means less heat, which means lower cooling costs. We're talking potentially hundreds of millions in operational savings per year for a big data center. For those customers, that kind of efficiency can be just as important, maybe even more important, than squeezing out the absolute last bit of performance.
Makes sense. Okay, so that's the tech moat. What about other advantages? You mentioned their location.
Right. There are other big advantages, geopolitical, really. Micron is the only major manufacturer of advanced memory based in the U.S.
Ah, the CHPS Act connection.
Precisely. That makes them a prime candidate, a primary beneficiary of the CHPS and Science Act. They've already got preliminary agreements for up to $6.14 billion in federal grants.
$6 billion. That certainly helps cushion their expansion plans.
It massively de-risks it. They're planning to invest, up to $125 billion in U.S. manufacturing over the next couple of decades. Having government support like that makes a huge difference. It's a real competitive advantage against Samsung and SK Hynix, who don't have that same level of U.S. government backing for U.S.-based production.
Okay, that's a serious amount of investment. So the story sounds great, the tech is there, the government support is there, but can the company actually afford this massive spending? Is their financial house in order?
Yeah, looking at the balance sheet, it really does look like a fortress right now. And you can see the financial turnaround clearly just by tracking those gross margins through fiscal 2025.
How did they progress?
Well, non-GAAP gross margin went from 37.9% in Q2, ticked up to 39.0% in Q3, and then that huge leap to 45.7% in Q4. That acceleration just proves that operating leverage is kicking in hard.
And what about cash? Do they have the liquidity? Are they burning through money on this CapEx?
They ended the fiscal year with almost $12 billion in cash on hand. Leverage is super low, debt to equity just 0.26. But the really powerful number is cash flow from operations.
How much is that?
For the full fiscal year 2025, a massive $17.53 billion. That's more than double the year before.
$17.5 billion. Wow. Why is that specific number so important for investors?
Because it shows they're funding their own growth.
Yeah.
Look, they spent $13.8 billion on CapEx last year, building out capacity, investing in that AI leadership. Huge spending.
Right.
But even after that massive investment, they still generated $3.72 billion in positive adjusted free cash flow. They weren't borrowing or issuing stock to fund the transition. The business itself generated enough cash. That's incredibly healthy. It creates this powerful cycle where success funds more investment, which leads to more success.
Very stabilizing. Okay, let's pivot then to the future. Opportunities and risks. We know the big opportunity is AI servers needing 5-6x more DRAM. What else is on the plus side?
Well, continuing execution on their product roadmap is key. They can't stand still. And they're already sampling a new HBM3E product with 50% more capacity.
The 36 gigabyte, 12 high stack.
That's the one. And they've got a clear plan to deliver the next generation, HBM4, in 2026. They need to keep pace with SK Hynix and meet whatever NVIDIA throws at them next. Staying on that cutting edge is critical. Plus, the whole onshoring trend, backed by the HPS Act, that's a multi-decade tailwind.
Okay, but let's get real. The bear case. Memory has always been cyclical. Every boom seems to end in a painful bust when everyone builds too much capacity. Why won't that happen again in, say, 2026 or 2027?
Look, that is absolutely the #1 historical risk. You can't ignore it. This cycle feels different because the AI demand seems so structural, so relentless.
But the three big players could still get caught up in an arms race.
It's possible. If Micron, Samsung, and SK Hynix all go full throttle building capacity at the same time, driven by these high prices, could they overshoot demand in 2026 or later? Yes. That could absolutely crater prices again, just like we've seen before. That risk hasn't vanished.
And there are other risks too, right? Geopolitics.
Yeah, definitely. The China situation is still out there. Remember back in 2023, China banned Micron chips from being used in critical infrastructure?
Right, and Micron pulled back from the server chip market there.
Exactly. So that's an ongoing tension, limits their market access, and then there's just plain competitive execution risk. Meaning, what if Samsung figures out its HBM problems faster than expected? They're a giant. They have huge resources. Or what if SK Hynix really accelerates its lead with HBM4? Micron's current advantage, this window of opportunity, it might not stay open as long as people think.
So summing it up, we have this company that looks structurally stronger, higher margins, huge growth tied to AI, great balance sheet. But it's still in a tough, historically volatile industry with smart competitors and real risks. How does the market value this right now?
Well, that's the crux of the investment argument, isn't it? The market still seems to be pricing Micron somewhat like its old cyclical self.
What's the valuation look like?
If you look at its forward price-to-earnings ratio, it's trading around, say, 22.8 times expected earnings. Now, compare that to another key AI player like NVIDIA.
Which is much higher, obviously.
Much higher. NVIDIA is trading at something like 53.8 times forward earnings, less than half the multiple for Micron.
So that gap, that's the opportunity. The idea that the market hasn't fully bought into Micron's transformation story yet?
That's precisely the thesis. The strong buy ratings are based on the idea that this valuation gap doesn't make sense anymore, that it has to narrow.
How do analysts get to their price targets, like that $240 consensus?
They take the consensus earnings estimates for, say, fiscal 2026, which are around $15.89 per share, and they apply a target forward PE multiple. And interestingly, they're often using a multiple of only around 15x.
15 times. That actually sounds kind of low for a company enabling the AI revolution.
It's arguably conservative, right? But even with that relatively modest multiple, you get to a price target around $240. The argument is simply that the fundamental shift we've discussed, more stable demand, much higher margins thanks to AI, justifies a higher multiple than the market is currently giving it.
So the core reason to consider buying now isn't just the growth, it's the potential for the stock's valuation multiple to expand as the market accepts this new reality.
Exactly. It feels like Micron's being penalized for its past volatility, even though the main driver of that volatility might be lessening because of these multi-year AI commitments.
Okay, so let's leave our listeners with a thought to chew on. Micron seems locked into NVIDIA's success for at least the next 2 years because HBM production is fully booked. Given that level of certainty,
Which is rare in tech.
very rare, what kind of shock, maybe technological, maybe geopolitical, could actually break that link before 2026 runs out? What could realistically derail those bookings and decouple Micron from NVIDIA's near-term trajectory? How fast could that risk actually hit?
That's the multi-billion-dollar question, isn't it? Thinking about that really tests how durable you believe this AI cycle truly is. But for today, the key point is this memory sector is changing, driven by AI becoming more profitable, and Micron, particularly with its energy-efficient HBM, looks incredibly well-positioned right in the middle of it all.
Great summary. That wraps up our deep dive on Micron technology, MU. We hope this gave you some valuable perspective on a really fascinating player in this market.